The Trump administration has floated the idea of a 50-year mortgage. In theory, it's supposed to help more people be able to afford homes, help first-time home buyers. But is that the case? Or is this really a trap disguised as a solution? Let's talk about it. This was an idea, a proposal. This is sort of a test balloon that this administration and previous administrations as well like to float ideas out to the general public to see how the response is, to see if it's something they want to pursue. And nearly universally, this idea has been panned by both critics and proponents of this administration, by mortgage professionals, by basically everyone in the housing industry. Everyone agrees that a 50-year mortgage is a bad idea. But why? Why is it such a bad idea? Let's break it down. First off, being in debt for 50 years, I'm relatively old school. I don't love debt. I'm not a big fan of debt. I understand that in housing, it's not the same as like credit card or consumer debt. But in general, the idea of paying off a loan for 50 years sounds awful. But then you look at the reality. Most people will have their mortgage for 7 to 10 years. And there are people on either side of that. But on average, it's probably somewhere around that 7 to 10 year mark. So why was this idea so universally panned? Why was everyone so up in arms about the idea of a 50-year mortgage? Well, there's a couple of reasons for that. But let's talk about some of the facts. Compared to a 30-year mortgage, when you look out over the payments of the life of the loan, amortize out the loan, you're probably going to save somewhere between $200 to $300 a month on your payment for I think it was something like a $500,000 house was the test that I'd seen. Which, look, don't get me wrong, $200 or $300 is great. If you wanted to send me $200 or $300 a month, I would happily accept it. But for most people, that doesn't really move the needle in terms of affordability. $200 doesn't suddenly make you able to buy homes that you otherwise couldn't. But on the other end, when you pay a mortgage for 50 years, the amount of interest that you're going to pay over the life of that loan is so much higher. I saw one estimate somewhere like 800,000, another was close to $1 million on a $500,000 house. The amount that loan is going to cost you, the money that goes to the bank or to the lender, is going to be significantly higher than on a 30-year loan. Not only that, but when you look at the way your payments are applied over the course of the loan, you pay interest early in the life of the loan, and then you pay off the principal later in the life of the loan. That way, lenders get their money back sooner than later, which for most people on a 30-year loan, which is already a very long timeline, they still are able to pay down principal over the course of their payments. They're still able to get some principal down on that loan so that when they turn around and sell their house, they have some equity. They're in a position where they can sell their house and have some money. And that's where, when we talk about homeownership as a way to financial wealth and freedom and things like that, that's where that comes from, because you are effectively paying down the debt on your home, and that equity, that amount of money that the home is worth that you no longer owe, while you can't reach over and grab that money, when you sell it, you'll be able to realize those gains. You will be able to get that money and either apply it towards the next house that you want to buy, or go fly to Cabo for a month. You can use that money for whatever you want because it's your money, because you've steadily been making payments. That amount that you owe has gone down lower and lower. And now you have money to do whatever you want to do with. The problem with a 50-year loan is the amount that you are going to now have in equity after 10 years is so much less than on a 30-year loan. So the amount of equity that you would have, we don't have hard and fast numbers for this because a lot of this is sort of plugging into calculators and kind of seeing what's going on. We don't have actual examples of this, but for the most part, the amount of equity that you're going to have in your home is significantly less. You know, over the course of, I saw one estimate was over the course of 7 years or so on the loan, a person who steadily made their payments might only have, $20K in equity, which $20K is look, $20,000. Again, you want to send me $20,000, I'll take it. But if I'm spending, $2,000 a month every single month for 7 years, I would hope that between the price appreciation of my home and the amount that I paid down, that gap, I would have more equity in my home. And that's just not the case with this potential product. But again, it's not real, but I want you to understand why this was so universally panned. The other piece of this that I think is really interesting is right now, we don't even have guidance for a 40-year mortgage. There are a couple of lenders who I think have begun to introduce the idea of a 40-year mortgage, but Fannie Mae and Freddie Mac are the two organizations that back most of our loans, like 70% of the conventional loans, I'm pretty sure, are originated or handled by them in some way, shape, or form. They don't have guidance for a 40-year mortgage. They certainly don't have guidance for a 50-year mortgage. So in general, right now, this is kind of a nothing burger. We're making all of these estimates based on current interest rates for 30-year mortgages, but that's not correct, because when you look at longer timelines on mortgages, they actually increase the rate. That's why you can get a better rate on a 15-year mortgage than you can on a 30-year mortgage. So it's cheaper to get those mortgages, but your payments are higher. So for most people, those can be a little challenging to get unless you're in a very strong cash position or you have a high income. For the median priced home, at least in Knoxville at 450, somewhere around there, a 15-year mortgage is hard for a lot of people from an affordability standpoint. So then what you do is you get a 30-year mortgage, which lowers your payment somewhat, but it increases the amount you're paying in interest, both in time and the interest rate. It would be a higher interest rate. So your payment may not even be that low, and you may be paying more in interest over the life of this loan than these crazy numbers that I've seen. So long story short, I think a 50-year mortgage is, I don't want to call it a trap, but at the end of the day, the only people who really benefit are the banks and the lenders. Or if you're in a position where you say, okay, I'm going to buy this, I'm going to sit on it for 50 years, and then I'm going to give it to my kids or my grandkids, and that may be your prerogative. That's totally fine. I have dreams and hopes for my kids and grandkids too. One of them is not paying a note for 50 years though. So at the end of the day, the thing that's going to help affordability is wage growth. There's a couple of factors to general affordability. A lot of it is supply and demand. Our listing inventory has increased to a generally sustainable level. We're not seeing the crazy spikes that we saw in '08 and the financial crisis, but we're also not seeing the very, very small, slim numbers that we saw during the 21 frenzy. And that's important because when we have more supply, then sellers and buyers alike are in a position where there's more negotiation. Prices of homes don't escalate rapidly. We don't typically see values fall, but we at least see things grow slowly. And that's what we want, slow growth. We want things to grow nice and nominally 3% a year, 2% a year, whatever it is, over the course of the next 30, 50, 100 years. The problem is when we see these rapid increases in price that come from a supply crunch, we are not seeing that same increase in our wages. I mean, most people aren't making 30, 50, 100% more in their income over the course of a year, but that's what's happening to house prices and home prices. So wage growth has to catch up, and it takes time. This happened in the 80s. Interest rates spiked in the 70s and the late 70s, and then affordability was tough, and then wage growth picked up, and then everything tends to equalize at some point because it is a free market, and we reach these equilibriums. But at the end of the day, a 50-year mortgage does not solve the affordability problem. In fact, it's going to make it worse because you're going to have people who are locked into these long-term mortgages without the equity they need to then make other moves in the future. So it's going to slow down the velocity of homes, which further crunches supply, which further crunches our ability to reach that affordability equilibrium. There are some other things that we can do to assist with affordability. A lot of that's going to happen on a local level because remember, there's no national housing market. There are local markets that make up the national housing market. And your neighborhood, your place may need zoning reform. It may need to make building easier. I know in Knoxville, infill lots are very expensive and infill building is expensive. Small, moderate sized homes, like a 3-bed, 2-bath, relatively close to downtown is getting very challenging because they're expensive. And building is not the smoothest process inside of the city. So I know there's a lot of ways that we can streamline that process, lower the cost to build, and therefore lower the cost of sale for most people. We're starting to see that supply-demand equilibrium hit. Builders can't build more homes than there are buyers for, unless the government or some entity chose to subsidize their builds and pay them a bunch of money to take a loss. At the end of the day, builders are not a charity, right? They're there to sell homes as a commodity. So we have to have some level of demand that can meet the supply, which is why that's always typically going to level out over time. They're going to only build what people will buy, period. So then we just have to make it so that people can buy more in terms of price, buy more in terms of their overall monthly budget. Because right now, most people, when they go to buy a house, it represents such a significant portion of their monthly budget. It's hard to make other decisions, do other things. And again, wage growth will help most of that. And that's going to happen naturally over time as the market forces increase our wages. Like that stuff is going to happen. It just takes time. And so when we have these interventions that are designed to help with demand, which is what a 50-year mortgage would do, it's on the demand side, not the supply side. In general, it's just not going to move the needle for most people, especially when the payment adjustment is $200 to $300 a month. Unfortunately, it doesn't do what I think this administration was hoping it would do. Even so much, and to be fair to them, they pretty much immediately said, "Okay, we hear you. We'll rethink it." So this isn't happening, but if it did, I don't recommend it. I would never recommend a client take on a 50-year mortgage. I think that's wild, but I'm not a lender, so a lender may have a different perspective, but most of my lender contacts have all agreed this is a bad idea. If you found this video helpful, hit like, subscribe, let me know in the comments what you're thinking. And until next time, thanks for watching.